$1.7 trillion gone in 90 minutes. I want you to really think about that number for a second. $1.7 trillion is more than the entire GDP of Spain, more than the GDP of Mexico, and it just vanished from the precious metals market in less time than it takes to watch a movie. This morning, gold was trading at $5,100. Silver hit an all-time high of $117.75. 90 minutes later, gold crashed to $5,000. Silver collapsed to $13. Gold dropped 2%. Silver dropped 12%. And if you are watching this wondering what just happened and whether you should be panicking right now, I need you to stay until the end of this video, because what I am about to show you completely changed how I see this crash. I'm going to pull up a 30-year chart that explains exactly why this crash happened and why it was actually predictable if you knew where to look. And I am going to show you what happened the last time silver touched this exact same price level. Spoiler, it went up 462% after that. But first, let me show you what actually caused $1.7 trillion to evaporate in 90 minutes. Welcome to the hidden economy. I break down the financial moves that mainstream media misses. Hit like and subscribe button if this video helps you understand what just happened, and let us get into it. So, here is what happened this morning that sent shockwaves through every trading floor on the planet. At approximately 900 a.m. Eastern Time, silver was trading at $117.75 per ounce. This was a brand new all-time high, the highest price silver has ever traded in recorded history. Gold was at $5,100, also near record highs. Everything looked bullish. Everyone was celebrating. Then within 90 minutes, silver crashed from $117 to $103, a $14 drop, 12% of its value gone in less than 2 hours. Gold dropped from $5,100 to around $5,000, a $100 drop, about 2%. Now, here is where it gets interesting. Gold dropped 2%, silver dropped 12%. Same market, same time frame. Completely different reactions. Why? That question is the key to understanding everything I'm about to tell you. Before I explain what caused this crash, I need to teach you something that will completely change how you look at price charts. And I promise to make this so simple that even if you have never looked at a chart in your life, you will understand it by the end of this section. When traders look at charts, they look for two things: support and resistance. Think of it like this. Imagine you are bouncing a ball in a room. The floor is support. Every time the ball hits the floor, it bounces back up. The ceiling is resistance. Every time the ball hits the ceiling, it bounces back down. In markets, support is a price level where buyers show up. Every time the price drops to that level, people say, "That is cheap, I want to buy." And the buying pressure pushes the price back up. Resistance is the opposite. It is a price level where sellers show up. Every time the price rises to that level, people say, "That is expensive, I want to sell." And the selling pressure pushes the price back down. I'm going to show you a 30-year chart now that made my jaw drop when I connected the dots. From 1996 to 2014, silver traded inside what we call a descending channel. Picture two diagonal lines going down from left to right with the price bouncing between them like a ball bouncing between two walls. During this entire 18-year period, there was one line in the middle of this channel that acted as a key level. We will call it the white line. In 2008, during the financial crisis, silver dropped all the way down and touched this white line. At that moment, silver was trading at $8 per ounce. $8. Now, pay attention to what happened next. After touching that white line in 2008, silver did not just bounce. It went absolutely parabolic from $8 in 2008. Silver ran all the way to $45 in 2011. That is a 462% gain in about 2.5 years. The white line was support. The ball hit the floor and bounced up hard. Now, fast forward to today. From 2014 to 2026, silver has been trading in a new upward channel. Picture two diagonal lines going up from left to right, and guess what just happened? Silver touched that same white line again, the exact same level that acted as support back in 2008. But here is the critical difference. In 2008, silver was coming down and hit the line from above. The line acted as support, the floor. In 2026, silver was coming up and hit the line from below. The line is now acting as resistance, the ceiling. The floor became the ceiling. And what happens when a ball hits a ceiling at high speed? It bounces back down hard. That is exactly what happened this morning. Silver hit a 30-year trend line that has defined major turning points in the market for 3 decades. The rejection was violent because the level is significant. This was not random. This was not manipulation. This was not a black swan event. This was a textbook technical reaction to a major multi-dead resistance level, and this is why gold only dropped 2%, while silver dropped 12%. Gold did not hit any major historical resistance level this morning, just got caught in the general precious metals sell-off. But silver hit the line that matters, the line that has defined this market for 30 years. Now you might be thinking, okay, so silver hit resistance and dropped. Does that mean the bull market is over? Should I sell everything? Not so fast. Let me tell you what happened after silver touched that white line in 2008. Remember, silver was at $8 when it touched the line in 2008. Over the next 2 years, it went to $45, a 462% gain. But here's what most people forget. Silver did not go straight from 8 to 45 in a smooth line. There were crashes along the way, violent ones, 30% drops, 40% drops, shakeouts that made people think the bull market was over. But the overall trend was up. And you know what else? In 2011, silver eventually broke through that white line resistance and went even higher. So here is the key question. Is this crash the end of the silver bull market, or is this just a normal correction within a larger uptrend, a shakeout before the next leg higher? Let me show you the evidence on both sides, and then you can decide for yourself. Now, I need to explain the second reason silver crashed 12% while gold only dropped 2%, because this part is crucial. The CME Group, which runs the COMEX exchange where most gold and silver futures trade, just did something that has historically marked major turning points in the precious metals market. They raised margin requirements. Let me explain what that means in the simplest possible terms. When you trade futures, you do not have to put up the full value of what you're buying. You put up a small percentage called margin as collateral. It is like a down payment. If silver is trading at $100 per ounce and a futures contract is for 5,000 ounces, that contract controls $500,000 worth of silver. But you do not need $500,000 to trade it. You might only need $20,000 in margin. That $20,000 controls $500,000. That is called leverage. Now here is what happens when the exchange raises margin requirements. Suddenly, that same trade requires $25,000 instead of $20,000 or $30,000 or $30,500, which is exactly what CME did last week. They raised silver margins by 47%, from around $22,000 to $32,500 per contract. If you are a trader who is fully leveraged, you now have a problem. You need to either add more cash to your account immediately or you have to close some of your positions. Most traders cannot add cash on short notice, so they are forced to sell. And when thousands of traders are forced to sell at the same time, what happens to the price? It crashes. This is called a liquidation cascade. Forced selling triggers. More forced selling as prices drop and more margin calls get triggered. The CME margin hike was the mechanical trigger. 9 days. Silver crashed from 50 to below 30 in weeks. And now in 2026, silver ran from around $30 to $117. CME raised margins by 47%. Silver crashed 12% in 90 minutes. Same playbook, different decade. The question is, what happens next? Because here's the thing that nobody is talking about. After the 1980 crash, silver entered a 20-year bear market. That crash was the end, but after the 2011 crash, silver dropped from 50 to below 15 over the following years. However, the bull market eventually resumed, and silver is now trading at over $100. So, the 2011 crash was not the end. It was a correction within a larger secular bull market. Which type of crash is this one? Let me give you the evidence and you can make your own decision. First, the bearish case. The reasons this crash might be the beginning of something worse. Silver has gone up 270% in 12 months. That is an insane move by any standard. Parabolic moves like this often end badly. The gold to silver ratio has compressed dramatically. When this ratio gets stretched too far, it often snaps back violently. Speculative positioning is at extreme levels. Everyone is on the same side of the trade. That is usually when the trade reverses. Margin hikes, historically marked, tops 1980, 2011, now 2026. Now the bullish case. The reasons this crash might be a buying opportunity. The fundamental supply and demand picture has not changed at all. China still restricted silver exports on January 1st. That is still in effect, that still affects 60 to 70% of global silver supply. Inventory is still down 70% from its peak. The registered silver available for delivery has collapsed from 86 million ounces to 28 million ounces. That has not changed. Industrial demand is still exploding. Solar panels need 200 million ounces per year and growing. Electric vehicles need silver. AI data centers need silver. 5G infrastructure needs silver. None of that changed this morning. The structural supply deficit is still the worst in history. 5 consecutive years of demand exceeding supply. 820 million ounce cumulative shortage. None of that changed. Physical silver in Shanghai is still trading at a $6 to $1 premium over the paper price. If the bull market was truly over, that premium would collapse. It has not. And here is the most important point. In 2008, when silver touched that white line at $8, the fundamentals were not this strong. There was no China export ban. There was no solar panel boom. There was no EV revolution. There was no AI infrastructure build-out. The fundamentals today are arguably the strongest they have ever been in silver market history. Yet the technical setup triggered a crash. This is the tension you need to understand. Technical factors can cause short-term crashes even when fundamentals are screaming bullish. The question is whether the technicals will ultimately bow to the fundamentals or whether the fundamentals will bow to the technicals. Historically, fundamentals win over the long term, but technicals can create tremendous pain in the short term. Now, let me tell you something that happened in the physical market today that almost nobody is reporting. While the paper price crashed 12%, guess what happened to physical silver premiums? They actually increased. Dealers were not lowering their prices by 12%. They were barely lowering them at all. Some actually raised premiums because demand spiked as bargain hunters tried to buy the dip. This is the same dynamic we saw in the nickel market in 2022. The paper price of nickel was trading at $20,000. Then physical supply got tight. The paper price exploded to over $100,000 in a matter of days because the paper market had to catch up to physical reality. Could the same thing happen in silver? Nobody knows for certain. But the divergence between paper prices and physical premiums is a warning sign that this market is not functioning normally. There are 356 paper claims for every 1 ounce of physical silver in COMEX vaults. That is not a typo. 356 to 1. That is like an airline selling 356 tickets for every seat on the plane. At some point, that math breaks. Let me give you some perspective on what we just witnessed. Silver dropping 12% in 90 minutes is one of the largest intraday moves in silver market history. The last time silver moved this violently was in September 2020. Before that, you have to go back to March 2020 during the crash. Before that, 2011. These types of moves only happen a few times per decade, and here's the pattern I want you to notice. Every single time silver has had a crash like this in the past 15 years, it has eventually recovered and made new highs. September 2020 crash, recovered, made new highs. March 2020 COVID crash, recovered, made new highs. 2011 crash took years, but eventually recovered and now trading at all-time highs. The crashes feel like the end of the world when they are happening, but looking back, they were just corrections within a larger bull market. Will this time be different? Maybe, but history suggests probably not. Now, I need to be very clear about something important. I'm not a financial advisor. This video is not financial advice. Silver is extremely volatile. As we just witnessed, prices can absolutely go lower from here. If you are leveraged in silver, you need to understand that margin hikes can wipe you out. Even if you are right about the long-term direction, being right does not matter if you get liquidated before the trade works. If you are considering buying this dip, you need to understand that catching a falling knife can be painful. The price could go lower before it goes higher. Do your own research. Understand your own risk tolerance. Make your own decisions. What I am saying is that based on my analysis, this crash was a technical event triggered by hitting 30-year resistance, combined with a mechanical event triggered by margin hikes. The fundamental picture has not changed. China still restricts exports. Supply deficits still persist. Industrial demand still grows. Physical premiums still exist. Those facts matter. Now, let me tell you what I am personally watching to determine whether this is a buying opportunity or the start of something worse. First, I'm watching the $100 level. If silver can hold above $100 and consolidate, that would be extremely bullish. It would suggest the crash was a healthy correction, not a trend reversal. As I record this video, silver has already bounced from 103 back to around 109. That is a good sign, but we need to see it hold. Second, I am watching physical premiums. If physical premiums collapse, that would be bearish. It would suggest real demand is weakening. So far, premiums are holding or even increasing. Bullish. Third, I'm watching COMC's inventory. If inventory starts rising, that would be bearish. It would suggest the supply squeeze is easing. So far, inventory continues to drain. Bullish. Fourth, I'm watching China. If China reverses its export restrictions, that would be bearish. So far, no signs of that. Bullish. Fifth, I am watching the CME. If they raise margins again, that would be bearish. More forced liquidation coming. We need to monitor their announcements. As of right now, 4 out of 5 indicators are bullish. Only the margin hike concern is negative. But that does not mean the pain is over. Markets can stay irrational longer than you can stay solvent. Be careful. Let me leave you with some historical perspective that I think is incredibly important. In 1980, when silver crashed from $50 to $10, everybody said precious metals were dead. The bull market was over. Gold and silver would never recover. 45 years later, gold is at $5,000. Silver is at over $100. The people who said it was over were spectacularly wrong. It just took decades to play out. In 2011, when silver crashed from 50 to below 15, everybody said the same thing. Precious metals are dead. The bull market is over. 15 years later, here we are at all-time highs. The crash always feels like the end when you're living through it. But zoom out and you see it is just a correction within a much larger story. The larger story is this. Global debt is at all-time highs, 38 trillion in the United States alone. That debt cannot be paid back in real terms. It can only be inflated away. Central banks are printing money at unprecedented rates. The Fed just announced $45 billion per month in reserve management purchases. That is $540 billion this year alone. Industrial demand for silver is structural and growing. Solar, EVs, AI, 5G, these trends are not going away. Supply is constrained and cannot respond quickly. 75% of silver comes as a byproduct of other mining. New mines take a decade to develop. These fundamental forces have not changed because of a 12% price drop. If anything, they are getting stronger. Now, I want to talk directly to 3 types of people who might be watching this video. The first type is the person who panicked this morning and sold. You saw the crash. You saw your account dropping. You felt the fear and you sold. I'm not going to tell you that you made a mistake. Maybe you did, maybe you did not. Only time will tell. But I will tell you this. Emotional decisions in volatile markets almost always feel right in the moment and look wrong in hindsight. If you sold purely out of fear and not based on any analysis, you should think carefully about why you made that decision. The second type is the person who is thinking about buying this dip. You see the crash as an opportunity. Lower prices mean better entry points. I will tell you this. Buying dips in bull markets is historically profitable, but buying too early in a correction can be painful. Silver could consolidate here. It could drop further. Be patient. Scale in. Do not bet everything on one price level. The third type is the person who has no position and is watching from the sidelines, wondering if now is the time to get in. I will tell you this. The best time to buy is when there's blood in the streets, when everyone is panicking, when the headlines are screaming crash. That is historically when the best opportunities emerge. But you need conviction based on research, not just gut feeling. Study the fundamentals, understand the technicals, make an informed decision. What is your situation? Drop it in the comments. I read every single one. Here is my final thought on this historic day. The crash was real. 12% in 90 minutes is violent and painful, but crashes do not happen in bear markets. Crashes happen when bull markets get overheated and need to reset. The fact that silver crashed from 117 means silver got to 117 in the first place. A year ago, it was $30. The trend is still up, even if the day was down. The margin hikes are concerning. They have marked tops before, but they have also marked temporary corrections before. We will not know which one this is for weeks or months. The 30-year resistance line is real. Silver hit a significant technical level and got rejected, but silver has broken through major resistance levels before and gone parabolic after. The fundamentals are unchanged. China restrictions, supply deficits, industrial demand, physical premiums, all still bullish. My conclusion is this crash was structural. It was predictable if you knew where to look. It was caused by technical resistance plus mechanical liquidation. But structural crashes within bull markets are opportunities, not endings. I'm not selling, I'm not panicking, I'm watching, I'm waiting, and I am preparing. Because if history rhymes and silver breaks through that 30-year resistance level, the move that follows could make the last 12 months look like a warm-up. In 2008, silver touched that line at $8. Then it went to 45, a 462% gain. Today, silver touched that line at 117. It pulled back to 103. Now it is back around 109. If silver eventually breaks through that resistance, where does it go? I will let you do that math. Drop a like and thanks in the comments. If this video helped you understand what happened today, I read every comment and I want to know what you're thinking. Share this with one person who was panicking this morning. They need to see this analysis before they make an emotional decision they will regret. Subscribe if you want to stay ahead of moves like this. I drop videos every week breaking down what mainstream media ignores. The crash came. The crash was violent. But the story is not over. Not even close. I will see you in the next one. Stay sharp out there. Oh, and one more thing before you go. I want to address the elephant in the room that nobody is talking about. Some people in the comments are going to say this crash was manipulation, that the big banks orchestrated this to shake out retail investors, that the CME raised margins specifically to protect short sellers who are about to get squeezed. Let me give you my honest take on that. Is it possible? Yes. Is it provable? No. Here is what we know for certain. JP Morgan was recently reported to have nearly $5 billion in unrealized losses on silver positions. They also reportedly flipped from a massive short position to owning roughly 750 million ounces of physical silver. The CME raised margins by 47% right as silver approached major technical resistance. The timing is suspicious. I will give you that. But here's the thing about markets. It does not actually matter whether this crash was manipulation or organic price action. The result is the same. Prices dropped. Leverage traders got liquidated, and now we have to deal with the aftermath. Spending energy being angry about potential manipulation does not make you money. Understanding the market structure and positioning accordingly does. So focus on what you can control. Your position size, your risk management, your entry and exit strategy. Let the conspiracy theories entertain you, but do not let them paralyze you. Now let me give you one final piece of data that I think is crucial. Do you know what happened to silver after every single CME margin hike in the last 50 years? In 1980, after the margin hikes, silver crashed from 50 to 10, but then over the next few decades, it eventually made it back to 50 and beyond. In 2011, after the margin hikes, silver crashed from 50 to 15, but then over the next decade and a half, it made it to over 100. In every single case, the margin hike caused short-term pain, but did not end the long-term bull case. Why? Because margin hikes address speculation. They do not address fundamentals. You can raise margins all you want. You cannot print physical silver. You cannot create industrial demand out of thin air. You cannot reverse China export restrictions with a margin hike. The margin hike is a speed bump, not a brick wall. And once the forced liquidation is over, once the weak hands have been shaken out, guess what is left? Strong hands, patient capital, long-term holders who understand that volatility is the price of admission for outsized returns. If you made it this far in the video, you're probably one of those strong hands. You did not panic. You did not close the video at the first sign of bad news. You stayed to understand the full picture. That mentality will serve you well, not just in precious metals, but in everything. Markets are designed to transfer wealth from the impatient to the patient, from the emotional to the rational, from the leveraged to the unleveraged. Be on the right side of that transfer. $1.7 trillion vanished today, but it did not disappear. It transferred from one set of hands to another. Make sure you are the hands receiving, not the hands giving. That is the game. Now you know the rules. Play accordingly. Give your valuable feedback in the comments if this helped. If you want to support me, you can join the channel. See you in the next